One man is about to decide when money flows and when markets suffocate. Not a billionaire, not a hedge fund legend, not a tech CEO. The next chairman of the Federal Reserve. Kevin Warsh is not coming to calm markets. He is not coming to protect your portfolio. He is not coming to preserve the comfort of the last decade. He is coming to stress test the entire financial system. He's willing to let the system catch fire before he reaches for the hose. If you are holding Bitcoin, gold, or tech stocks, the rules of liquidity you've relied on for a decade are about to be shredded. Today, we're looking at the Warsh Doctrine and why your portfolio might not survive the transition if you don't pivot now. To understand your investments in 2026, you have to understand the man who will soon control the price of money. Kevin Warsh isn't some academic outsider. He is a veteran of the machine. He served as a Fed governor from 2006 to 2011. He was in the room where it happened during the 2008 Great Financial Crisis. He helped design the bank rescues and the very first rounds of quantitative easing, or QE. But here is the breakthrough insight. After leaving the Fed, Warsh became its most articulate critic. He watched the monster he helped create, this addiction to money printing, and he turned against it. He's argued for years that the Fed has become too cozy with the markets, acting as a helicopter parent that refuses to let the economy scrape its knee. In my years of consulting, I've learned that the most dangerous leaders are the ones who know the system from the inside, but have developed a philosophical grudge against its current operations. Warsh isn't coming in to manage the Powell legacy. He's coming in to reform the institution. He wants a Fed that is smaller, quieter, and less predictable. For an investor, less predictable usually means one thing: volatility. Under Jerome Powell, the Fed operated on preventive maintenance, injecting steady monthly liquidity to keep markets calm, even at the cost of higher inflation and a weakening dollar. This constant support prevented crises, but created a permanent dependency on easy money. Kevin Warsh represents a sharp shift. He wants to end the steady drip and allow stress to surface. Instead of preventing every emergency, Warsh believes the Fed should intervene only during full-scale panics, using massive, concentrated stimulus. In practical terms, Powell offered steady liquidity, while Warsh plans lumpy liquidity, long periods of tight conditions followed by explosive interventions. For investors, this means the traditional Fed put is gone. Markets may fall far deeper before any rescue arrives, making large drawdowns a normal feature of the new regime. There's a video of Warsh from his time during the '08 crisis where he explains his philosophy perfectly. He says central banks are created to respond to panics by showing overwhelming force. He believes the Fed should be the backstop of last resort, not the market maker of first resort. But here's the advisor's insight that the media is missing. The outcome is the same, but the journey is more painful. Whether you print $40 billion a month steadily, the Powell path, or print $2 trillion in a single weekend after a crash, the Warsh path, the total amount of currency debasement at the end of the year is virtually identical. It's like asking if you want to be paid monthly or bi-monthly. At the end of the month, the total in your bank account is the same. However, the stress on the system is vastly different. Warsh's plan introduces a liquidity gap. By stopping the steady flow, he's inviting a crisis, and while he thinks a phoenix will rise from the ashes, most investors aren't phoenixes. They're just birds that get caught in the fire. Warsh isn't offering a solution to inflation. He's just changing the timing of the money printing. It's a switcheroo that creates more drama, but the same devaluation. So, what does this mean for your portfolio? In the short term, policy uncertainty. Markets hate a mystery, and Warsh is a known unknown. I expect a massive rotation in the stock market. For the last few years, speculative growth stocks, the ones that don't make money but have great stories, have thrived on Powell's steady liquidity. When that liquidity becomes lumpy and uncertain, those stocks will be slaughtered. If I were sitting across from a high net worth client today, I'd tell them to look at value stocks, companies with real cash flow, real dividends, and fortress balance sheets. Why? Because when Warsh stops the printing press to test the market's strength, only the companies that can fund themselves will survive the winter. We are moving from an era of easy money to an era of hard earnings. The stock market won't die, but the zombie companies kept alive by Fed liquidity certainly will. Now, let's talk about the elephant in the digital room, Bitcoin. I've had many breakthroughs with crypto investors who think Bitcoin is a hedge against the system, and in the long term, it is. But in the short term, Bitcoin trades like an amplified tech stock. It is a liquidity sponge. When the Fed prints, Bitcoin soars. When the Fed tightens, Bitcoin bleeds. If Kevin Warsh follows through with his promise to restrict liquidity until an emergency happens, Warsh will be the worst Fed chair in history for Bitcoin. Bitcoin thrives on the steady drip of dollar devaluation. If Warsh creates a liquidity vacuum for 6 months to prove a point about sound money, Bitcoin could see a drawdown that makes previous bear markets look like a dip. However, don't miss the forest for the trees. The moment Warsh finally does print, the moment he uses that overwhelming force to stop the panic he allowed to happen, Bitcoin will likely have the fastest, most violent recovery in history. The 2026 play for Bitcoin isn't buy and hold, it's survive the gap and buy the panic. What about the old guard, gold and silver? For my precious metals investors, the Warsh nomination is actually a non-event in the long run. Why? Because Warsh isn't offering a solution to the $36 trillion national debt. He's not offering a way to stop de-dollarization or the global shift towards BRICS. He's just talking about timing. Inflation doesn't care if the money is printed steadily or lumpily. The debasement of the dollar is a math problem, not a personality problem. Gold and silver represent a lack of confidence in the US dollar, and Warsh, despite his tough talk, will eventually have to print to save the banking system, just like he did in 2008. In fact, the Warsh volatility might actually drive more central banks to buy gold as they realize the US Fed is becoming more erratic. If you're a long-term gold holder, stay the course. The lumpy printing path still leads to the same destination, a devalued currency and higher nominal prices for real assets. We have to address the bait and switch possibility. Why would President Trump, a man who loves low interest rates and a booming stock market, nominate a hawk like Warsh who wants to restrict liquidity? There is a high probability that this is a strategic performance. Warsh might talk about tightening and letting it burn to regain the Fed's credibility, but when the midterm elections approach or the market drops 15%, the switcheroo happens. Trump and Warsh could easily decide to run it hot to ensure the economy feels good for the voters. I've seen this good cop, bad cop routine before in the corporate world. You bring in a tough guy to scare the markets into efficiency, but the moment things get real, you revert to the printing press. Don't be fooled by the sound money rhetoric. In a debt-based system, the Fed must print or the system collapses. Warsh knows this. He supported the doubling of the balance sheet in 2008. He isn't a monk, he's a fireman who likes to wait for a bigger fire. The takeaway for 2026 is clear. Volatility is the new rent. You are going to have to pay it if you want to live in this market. Kevin Warsh is moving us from a regime of steady erosion to a regime of violent spikes. If you are a speculative investor, you are in danger. If you are a value-driven architect of wealth, you are about to see the buying opportunity of a lifetime when that overwhelming force eventually hits the fan. The Fed is changing, the chair is changing, but the math of the dollar remains the same. If you want to see exactly how I'm positioning my personal portfolio to survive the Warsh gap and catch the overwhelming force recovery, you need to be on the inside. Comment below, who do you trust more with your money? Powell's steady drip or Warsh's overwhelming force? Subscribe to stay ahead of the Fed, and I'll see you in the next strategy session. I wish you a very profitable day. Take care.